I'm Gentiana Sharku. I'm lecturer at Faculty of Economy, University of Tirana. Today, I'm going to discuss how insurance is used as a technique for disaster risk management. This short webinar will briefly review some concepts regarding the risk management. It will analyze the kinds of risk transferred through insurance, how the insurance mechanism is dealing with disaster risk, and which are the alternatives available to insurance market to cover disaster losses. At the end of the chapter, several case studies demonstrate the way by which insurance market deals with disaster risk. First of all, we cannot discuss about insurance without saying two words about risk. Insurance is developed due to the existence of risk. At a glance, risks seem to be a very simple notion. When there is a risky situation, one may think that there is possibility of loss or an unpleasant outcome. The financial literature provides several definitions of risk, depending on the field or the purpose of use. However, in general, risk has been defined in terms of two elements, uncertainty and loss. In insurance, risk is defined as uncertainty that loss may occur in the future. In general, individuals wrongly use the terms of risk and probability instead of each other. It is necessary to distinguish between the risk and probability. Probability refers to the long-run chance or frequency of loss. For example, the probability of the damage of a building from fire may be 0.2%, while risk may be 10 or 5%, depending on the variation of actual losses from expected loss. Other concepts related to risk are peril and hazard. Peril is defined as the cause of loss. Hazard is defined as the condition that creates or increases the frequency or the severity of loss from a peril. For example, one of the perils that can cause an auto damage is a collision. The collision is a peril, which is the direct cause of loss. Why does collision occur? By this question, we find a hazard, the icy street, or the high speed above the load limit, or the frost. Each of these hazards may increase the probability of a collision. The risky situations are not pleasant to individuals. The presence of risk results in undesirable social and economic effects. As a result, most people try to avoid risk as much as possible, or to reduce its negative consequences. In general, the individuals are risk-averse, which means that they generally are willing to pay in order to reduce the risk, or they would like to be compensated if they take more risk. Risk management is a process that identifies loss exposures faced by an organization or individual and selects the most appropriate techniques for treating such exposures. Risk management process involves 4 steps. Risk identification, which identifies all sources of risk, actual, anticipated, and perceived. Risk quantification, which estimates the financial impact on the firm of all pure and speculative risk identified. The financial impact may be estimated by determining the severity and the frequency of the loss, by which risk manager can select the appropriate technique for risk management. Risk management, which decides how to handle risk, and risk monitoring, which tracks and evaluates the performance of the risk management strategy. There are 6 basic methods of handling risk, which can be classified in 2 groups. Risk control techniques, which include avoidance, which means that the risk is abandoned, prevention, which refers to the measures that reduce the loss frequency, reduction, which refers to the measures that reduce the loss severity, diversification, which reduce the risk by spreading the loss exposures among different parties, and risk financing techniques, which include retention, by which an organization or individual retain a part or all losses that can result from a given risk, transfers through contracts, like hedging and insurance. In order to determine the appropriate risk management techniques, risk manager may use the following table, which classify the losses according to their frequency and severity. And now, let's come back to insurance. What insurance is? The transfer of risk from individual to the insurance company is carried through an agreement under which the insurance company, in consideration of the premium paid by the insured and is promised to obey the provisions of the contract, promises to make payment to or on behalf of the insured for losses caused by the perils covered under the contract. The main purpose of the insurance is to indemnify the insured. The indemnification is possible through the process of pooling and sharing of losses. The losses suffered by a small group of insured are spread on the entire group of insureds, and the average loss substitutes the large actual loss. But insurance companies do not cover all kinds of risk. There are two types of risk: pure and speculative. Pure risk is a category of risk in which the outcome is either loss or no loss. Examples of pure risk include the uncertainty of loss of one's life or property by fire, flood, windstorms, earthquakes, and other perils. The speculative risk is a category of risk in which the outcome will be either for profit or loss. Examples of speculative risk include the business venture, gambling transaction, investing in real estate or stocks, etc. Insurers generally insure only pure risk. There are some requirements that should be met before pure risk can be privately insured. There must be a sufficiently large number of similar exposure units. Insurers use the law of large number to predict probable losses. Therefore, it's essential that a large number of independent and similar units be exposed at the same peril. The loss must be accidental and unintentional, which means that the loss should be beyond the control of the insured. The loss should be definite and measurable. The loss must be determined regarding the time, cause, place, and amount. The loss should not be catastrophic. The insurance principle is based on the notion of sharing losses. If all the exposure units in a certain class incur a loss at the same time, the pooling technique will fail, and the insurance will be no longer an effective technique. The chance of loss must be calculable. The insurer must be able to calculate the probability of loss. And finally, the premium must be economically feasible. The insurers collect the premium to pay the losses, the loss adjustment expenses, and to provide a profit for themselves. The rates charged by insurance should be adequate to pay all losses and expenses, and they should not be excessive, in order that insured pay no more than their coverage. After all, does a natural disaster risk satisfy the requirements of an insurable risk? According to the above classification, the natural disaster risk is a pure risk, as the society does not benefit when a natural disaster loss occurs. The natural disaster risk meets the following requirements. There is a large number of units exposed to the natural disaster hazards. The losses resulted from a natural disaster risk are out of the individual control. They are accidental and unintentional. If insurers cover a sufficiently large group of exposures, the premium may be feasible. But natural disaster risk does not fully meet the following requirements. When a natural disaster takes place, often it's very difficult to measure the amount of loss, or at least the actual loss can be measured only after a certain period of time. The loss is catastrophic, the disaster occurs on a regular basis, therefore their probability cannot be accurately estimated. However, insurance companies have found solutions to use the resources of the financial market to meet the problem of catastrophic losses. There are at least four basic methods that allow them to accept exposures that otherwise would have been refused. First, reinsurance is a method created to divide the risk among several insurance companies. Reinsurance is the shifting of a part or the whole risk written by one insurer, called the ceding insurer, to another insurer, called the reinsurer. The transaction is carried through agreements, called treaties, which specify the ways in which risk will be shared by the parties. The excess loss treaty is designed largely for catastrophic protection. Losses in excess of the retention limit are paid by the reinsurer up to the sum maximum limit. Second, distributing their coverage over a large geographic area, and as a result, the possibility of catastrophic loss will be reduced. If a multinational insurance company would cover the fires in Russia, the earthquakes in Italy, and the flood in France, then the insurance company would have a more diversified portfolio and will have more stable financial results. Third, insurance companies use the financial market to transfer a part or all the catastrophic risk to investors in the form of insurance-linked securities. Examples of insurance-linked securities are contingent surplus notes, catastrophe bonds, and exchange-traded options. Contingent surplus notes allow an insurance company to protect itself from paying a large number of claims resulting from a disaster. The investors put the funds in a trustee that buys treasury securities. If a catastrophe occurs, the insurer has the legal right to replace the government securities with its own contingent notes. Catastrophe bonds are another financial arrangement that allow insurance companies to transfer the risk of catastrophe. Catastrophe bonds are special bonds issued by insurance companies to help them pay for natural catastrophic losses. The investors put the fund in a trustee, called the special vehicle purpose, and buy safe securities and other high-quality securities. The cat bonds are usually rated below investment grade and pay relatively high yields. If a catastrophe event occurs, the insurance company can withdraw funds from the special vehicle purpose to pay claims, and no repayment is made to the investors. If the specified catastrophe event does not occur, the investors receive their principal plus interest that is relatively high. The insurance companies can transfer the catastrophe risk through exchange-traded options, which are sold by speculators and purchased by insurance companies. The insurance company has the right to a cash payment from the seller if a specified index of catastrophe losses reaches a certain level within a specified time period. And finally, microinsurance, which aims to provide insurance against natural disasters to poor individuals. It's a financial device that provides low-income households, farmers, and business with access to post-disaster liquidity, thus securing their livings and providing their reconstruction. What part of disaster risk is actually insured all over the world? According to the Swiss Re Sigma publication, economic losses from natural catastrophes and man-made disasters across the world were estimated $337 billion in 2017, out of which $330 billion were natural catastrophe-related economic losses. The insurance industry covered about $144 billion, more than two-fifths of the economic losses. The figure shows the difference between insured and economic losses over time, termed the insurance protection gap. How the natural disaster risk is handled in selected countries. Disaster risk insurance schemes often require partnerships between governments, international organizations, and the insurance industry. Some examples of public-private insurance programs implemented in several countries are as follows. In Mongolia, herders can purchase an index-based insurance policy to protect them against livestock losses due to the conditions of extreme winter weather. The insurance program is a combination of self-insurance, market-based insurance, and social safety net. Small losses are retained by the herders, while larger losses are transferred to the private insurance industry. Only the final layer of catastrophic losses is faced by the government. In France, private insurers are required to offer catastrophe insurance in all hazard property policies. Policies are not risk-based and the program is reinsured through public administered fund. If the fund does not satisfy the claims, taxpayer will be called to pay. The Mexican government has chosen to insure its catastrophic reserve fund against earthquakes with a mix of reinsurance and a catastrophe bond. It was the first country that issued a multi-peril, multi-region cat bond using the World Bank's multi-cat program. According to the Turkish catastrophe insurance pool, earthquake insurance policies are obligatory for all property owners in Istanbul and other high-risk urban centers. Apartment owners pay a premium based partially on their risk to a privately administered public fund. If the fund cannot meet claims after a major earthquake, the World Bank provides a contingent fund to the pool. The Caribbean Catastrophe Risk Insurance Facility went into operation in June 2007, and it has been the world's first multi-country catastrophe insurance pool, reinsured in capital markets to provide governments with immediate liquidity in case of large losses due to hurricanes and earthquakes. In Romania, in 2008, the pool against natural catastrophes was set up as an insurance company, formed by the Association of 12 Insurance Companies. The insurers, which are members of Catastrophe Insurance Pool, sell mandatory indemnity-based insurance against earthquakes, floods, and landslides. As conclusion, managing the losses resulted from disaster events is a challenge for every country. There are several traditional forms of risk management, from loss control to loss financing, and insurance is one of them. But in case of disasters, insurers often require partnerships between government, individuals, and international organizations. Especially in developing countries, the losses resulted from disaster risk constitute a large burden to the state budget. It's a time to share this burden with other operators in the market. Thank you all for your attention.